Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. Today we want to look at how we can be able to compute the weighted average cost of capital, or WACC. This is the weighted average cost of capital, or what we abbreviate as WACC computation. So we have now been able to get we have been able to compute the specific cost of each source that we can be used. So just to link up what we discussed earlier, the issue starts if the company is geared, meaning that a company has debt in its capital structure. So when the company is geared, it means they have both debt and equity in their capital structure. They have two components. They have the component of debt and the component of equity. Therefore, the examiner will give you what we call a balance sheet extract. It will be a balance sheet extract where you will be seeing these different sources of finance that are making up the capital structure of an entity. Now, in this paper, Advanced Financial Management, you have to think, and it's not going to be like the way we did in the financial management on level 2. The examiner will not tell you to compute WACC. Neither will the examiner tell you to compute MWACC. This is the marginal, because on level 2 we computed two things, WACC and MWACC. The marginal cost, the marginal weighted cost of capital, this is the MWACC, or WACC, which is the weighted average cost of capital, WACC. So here the examiner will not tell you, but he will only tell you to compute the appropriate. What they use here, they use the word appropriate cost of capital. So the examiner will tell you to compute the appropriate cost of capital. And it will depend on the information that you have in the question. So once the information you have is enough for you to compute MWACC, you do so. If the information that is available can only enable you to compute weighted average cost of capital, then you go ahead and do that. If it is the information available is only for you to compute the cost of equity, cost of debt, you do so. So the appropriate cost of capital, once a company is geared, is what we call WACC. The appropriate cost of capital. If the company has both debt and equity, the appropriate one is WACC. That is weighted average cost of capital. And we said the formula for computing WACC is VE, that is value of equity, over value of equity plus value of debt, VD, times KE, this is cost of equity, KE, cost of equity, plus value of debt over value of debt plus value of equity. But this time around we multiply by KD. But this KD should be adjusted for tax 1 minus T. It should be always adjusted for tax. So let me rearrange it well. So where VE is the value of equity, VD is the value of debt, KE is the cost of equity, this is KE, of course KD is the cost of debt, and then we have the T, which is the tax rate. But remember here, we said we always use the market values. So here we go by the market values. So you should be knowing how to compute WACC using market values. So here we are going by the market values. But the VE and the VD, this VE and the VD, the value of equity and then the value of debt, must be market values. These ones must be market values. And the examiner may not give you the market values in the question, but this is part of your workings, and you will get the marks for those workings. So we saw these things on how we can compute the value of equity, the value of debt, and others using the market values. We saw how to do the market capitalization. But we have also to repeat them here because there are small issues that are always going to be confusing students. So we need to be able to, we shall do them again. However, in the formula, as you can see in this formula for the WACC, the trouble is the only trouble that you are going to find is getting this KE, cost of equity. So you need to see in the question, how is the cost of equity behaving? In other words, how are we going to be doing the cost of equity? So we agreed that this cost of equity is the one that is going to cause us a problem, because the rest we know how to compute them. But we also agreed that cost of equity can be got using CAPM. This is capital asset pricing model. Though I haven't taught you how to use CAPM, but just know that's one of the ways how we can get the cost of equity. However, the examiner is not going to tell you whether you should use CAPM, whether you should use Gordon model or M&M. So it is all about you to find what information that is available. You will know which one you are going to use depending on the information that is available. Finally, we also said that we can use Gordon model and also M&M model or Modiglian and Miller. And I want to look at M&M when we go to capital structure theories. It's a topic that we are going to look at, and we shall see what these people say about all this kind of stuff. However, the examiner can bring to you a standalone number that is all about that Modiglian and Miller, M&M. So it can be a standalone number to explain. It can be to explain M&M, or it can be in terms of computations. Of course, you know, when you're explaining, at least you try to put in, if there is a formula, you try to put it out. But what I want you to understand is that we can also use it to compute cost of equity. Therefore, when as a business or as a company, as long as you find yourself that you are geared, you have both debt and equity, then we say the appropriate cost of capital is basically the WACC. But now, we've seen how we are going to be solving the cost of equity. We want to understand how are we going to be dealing with cost of debt. That is the KD, the cost of debt. This one has no problem. Cost of debt, KD, has no trouble in computing it. If it is a bond, debenture, you only find out whether it is redeemable or irredeemable. And it has no complications. But the problem is only on this cost of equity, because the decision is always on the student to know which formula or which method to use. So today I'm going to teach you the Modiglian and Miller, and as I said, we are going to learn it under the capital market theories, and I will teach you the Modiglian and Miller capital structure point of view. And of course, when we are done looking at the capital structure point of view, I will actually conclude with it when we are seeing how we can use it to compute the cost of equity. That's how I think it may actually make sense. Yeah, but the good thing, we have seen the formula for WACC. We need to know how we compute the market values, because they are the ones that are very useful, because we said VE and VD, they are supposed to be market values when computing WACC. So let's look at how do we compute each of these market values for both debt and equity. And that's basically what we are going to do in the next video. So let's meet in the next video as we are talking about the determination of the market values for both debt and equity.